Netflix stock is over 50% down year to date. And just recently, Netflix published its Q3 earnings, and the stock went up by over 20%. So let's take a quick look at the earnings, and then let's value Netflix and see, is it an interesting investment opportunity at this new price? Revenue is up year over year from $7.5 billion to $7.9 billion. That is around 5% growth. But earnings are down from $1.449 billion to $1.398 billion. So the costs are going up for Netflix, and they are going up faster than the revenue. Netflix also bought back some of its shares, so they are using the lower valuation to get some value back to the shareholders. And cash equivalents are down a lot, from $7.5 billion to just $6.1 billion. So they are spending a lot of money to run their business. But also, they are paying back their long-term debt, which is down from $14.8 billion to $13.8 billion. So that is a good trend to see. We also see a positive trend regarding the free cash flow. They have a positive free cash flow, and last year it was negative. So we can see a number of positive trends, and that is why the price went up. But to really understand how Netflix is doing, we have to look at it from a long-term perspective. So let's start with finding out who owns Netflix. Insider ownership, that is an X. Individual insiders own only 1.3% of the company. And we are looking for a number higher than 2%, because then we know that the people that are running the company have their own money invested in it. And in such a scenario, they will take care of the shareholders, because they are the shareholders. And are they buying? That is a check. But the last buy that we know of was in January, and after that we do not have any data of selling or buying from insiders. And it was Wilmot Hastings, co-founder and CEO of Netflix, and he bought shares worth $20 million. And do super investors own Netflix? That is a check. There are 8 super investors that have their money in this company. And are they buying? That is an X. Data from Q2 and the first data we have from Q3 show that they bought over 700,000 shares and sold 3.4 million shares. Okay, so it is a mixed situation regarding investors. So now let's take a look at the financial health of Netflix. Return on invested capital, that is an X. It is on average 8.5% in the last 10 years, and we are looking for a return of over 10%. And free cash flow growth, that is a check with 36% growth. But it was a bumpy road with a lot of years with a significant negative free cash flow. So it is not a stable business from a free cash flow perspective, even though it has an impressive growth in the last 10 years or so. And what about the net profit margin? That is a check. It is 16%. And Disney has a net profit margin of 3.9%. And Warner Bros. Discovery has a negative margin of minus 14.3%. So the average sector margin is around 5.6%. And that means that Netflix has a strong pricing power. So this is an important thing to keep in mind. Okay, and now shares buyback. That is an X. They issued 9.5% more shares in the last 10 years. So they are diluting their investors. And what about the debt? that is also an X. It would take them over 19 years to pay their long-term debt with a current free cash flow. We know from the recent Q3 earnings that they are paying their debt back, but still it is a massive debt. And is Netflix paying a dividend? That is an X. They are not currently paying any dividends. Okay, so now that we got some fundamental info about this company, let's use a discounted cash flow formula to find the intrinsic value of Netflix. We will have to estimate the growth of Netflix for the next 10 years, and we will make 3 scenarios with different growth rates. So, for the low scenario, let's estimate a growth of 10% for the first 5 years and then 8%. For the medium scenario, 15% for the entire 10 years. And in the high scenario, a 25% growth for the first 5 years and then 20% growth for another 5 years. So basically around the same level as they had for the last 10 years. And an intrinsic value is $61 in the low scenario, $93 in the medium, and $163 in the high one. But these are not the prices we should be looking for, because we have to add a margin of safety. That way, we create a room for error. We can be wrong with our estimates and still not get into any serious trouble. I use a 30% margin of safety. So, with such a margin, the price in the low scenario is around $42, $65 in the medium, and $114 in the high one. And the current share price is $290. So it is not even close to the price that we should be looking for. But the recent low in June was around $175, so not that far off the high scenario. And I understand that this is a company that is trying to grow and that has a business that needs a lot of money put into it. And so maybe the discounted free cash flow formula is not the best way to value this company. But still, for me, it is just too risky to invest. I do not have to understand every business, but if I see that they do not have a stable free cash flow growth, that they have an incredibly high debt, and that they are diluting their shareholders, then, as Warren Buffett says, I do not have to swing. I will wait for an opportunity that is a no-brainer for me, that I can easily understand. But of course, if you have a different opinion, if you see great value in Netflix, then please tell me in the comments what am I missing and why you believe that it is going to be a great business in the future. And remember that before making any financial decisions, you should always do your own due diligence and treat this valuation only as the first step in understanding the company. That's it for today. Thanks for watching, and don't forget to like this video if you found it interesting and subscribe to the channel if you want to see more videos like this one. Thanks again and see you in the next one. Bye bye.